Hey, this is Jeffrey with another edition of Stock Smart, the March 29, 2021 edition. Hope you're doing well. So big news today. Nomura and Credit Suisse, they warned of large losses after a fire sale of about 20 billion of Chinese and US stocks as their client ARCHEGOS Capital Management was forced into a huge unwinding of positions on Friday. So you're looking at a few of these stocks, Viacom CBS, which is VIAC, down about 50% last week. Discovery A, DSCA, down about 50% this last week. And Farfetch. So what happened here? Okay, so ARCHEGOS essentially is a family office. So no one knew about these large positions they were taking. ARCHEGOS was taking a lot of leverage positions, buying essentially on credit, buying derivatives and swaps of stocks. So family offices, usually what would happen if someone was accumulating huge positions, like over 10%, you'd know about it because you'd see it in the 13F that they have to file with the SEC. Because once you have under over 100 million in management, you have to file a 13F, and you would be able to see then if anybody was accumulating a large position. But there's this little loophole, of course, and this is the total manipulation of the stock market. This is what this is. So if you have a family office, you don't have to register with the SEC. In fact, you could just be managing money. Like it could be like my mom managing everyone in my family's office in the family, all their money. And she doesn't have to even be an advisor or registered or licensed or anything. So family office gets this exclusion. And I'm going to read the exclusion. Family offices are excluded from regulation under the Investment Advisor Act of 1940. Family offices are entities established by wealthy families to manage their wealth and provide other services to family members, such as tax and estate planning services. Historically, most family offices have not been registered as investment advisors under the Act because of the private advisor exemption. So again, if they have less than 15 clients, which is ARCHEGOS pretty much just had one massive client, they can keep everything without disclosure to the SEC. So ARCHEGOS never even had a filing with the SEC, which is ridiculous, totally manipulative. And let's talk about what they did. So problem number one is that they didn't have to disclose anything because they weren't registered with the SEC. Problem number two, and so let's go into what happened again. So they bought a lot of positions. They used leverage, so they borrowed money from these huge institutions like Credit Suisse and Nomura and Goldman Sachs. They borrowed a lot of money to buy more positions. Now, if you want to even accumulate more positions at a less of a cost, you just buy call options because they're so much cheaper. I mean, you could buy hundreds and hundreds and hundreds of call options for the price of like a third of the stock. So you could be heavily positioned just through your option positioning. So here's what they did. This is one of the primary problems. They're using swaps and derivatives, which don't cost as much to play with as if you had to buy the underlying stock. So this is a classic thing. This is what SoftBank did earlier in the year when they took advantage last year of the market being down and essentially front ran a lot of positions in stocks. And what they did is they bought it up, they bought it down. People actually, by the way, people got that short. People actually took advantage of the short. And I'm going to tell you how this happened and it hasn't all but come out, but this is probably what happened. Because if they had derivatives, you know that they were front running probably the derivatives. And let me explain this. So if I buy Viacom CBS, right? What I'd want to do first, I know I'm going to put a huge position in Viacom CBS, and it doesn't have so much stock on there, and the stock price was so small, you could really move it by buying X number of shares. So let's say I was going to buy Viacom CBS or Discovery, and I was going to buy a huge position, like 100, 300, 400 million dollars worth of shares. What I would do, and this is illegal, it's called front running. What you would do is you essentially, but in this case, it's not going to be considered illegal because it was probably for the same family account. I mean, I'm talking about in the case of ARCHEGOS. But if you front run like a client's positions or something like that, that's illegal. So let's see what they did. Here's what they did. They bought call options, so long positioning options, which are inexpensive compared to owning the stock. And then they bumped the stock up by buying the underlying stock. It's exactly what SoftBank was accused of doing last year. So yeah, that's market manipulation. Okay? Market manipulation. And you can do it on stocks with low numbers where the stock's really been decimated or gone down. A lot of these cable type or media stocks have done that. And you can easily make them move and benefit. So here all of a sudden now you bump the stock up $20, well, your call option is going to be worth tons of money. Then you take the money back out, sell it, get rid of the call, buy it again. Boom, bump it, buy it again. Now, this family office, now you would know if somebody was like when Buffett accumulates a large position, generally he wants to accumulate. If he's in something, they buy 10% when they can and when they're really interested in a company. But you would know it because Buffett, Berkshire Hathaway has to follow 13F. This family office does not have to disclose anything. So they can get away with this. So this is manipulation. This law will change. I guarantee it, because they manipulated the system by having just one family of investors, thereby being like under the wire or under the radar here of the SEC and under the radar of investors. And guess who gets hurt in the end? But an average investor who bought Discovery at $120 or whatever it went up to. Somebody who got hit and then the stock fell to the earth and people were just buying it because of momentum. So people got hit because of this guy ARCHEGOS, who's probably going to get heavily fined and probably could go to jail for this. So it'll depend what comes out. He probably was within the legality of it because it was the family office kind of exemption or exception, but total stock manipulation. Let's talk about crypto really quickly. Latest news on crypto, 13 to 14% of Americans own some form of cryptocurrency. That's pretty cool. That's a gigantic number. More than I would have expected, but I read this today. It's becoming an asset class. And the more that it's accepted, the better future and more stability it'll have. Market overall, come on, very flat today. Down slightly. We are getting oversold. I think the move in the positive direction will come closer to when we start these earnings. So in about 2 weeks, say April 15th, we're going to start seeing bank earnings. And bank earnings generally will be the kickoff to the earnings season. So we're going to get bank earnings. I think the bank earnings are going to disappoint because the banks are so overdone, going up about 30% in 3 months. So once that starts, then people will have catalysts again in some of these tech stocks, which are so oversold. So you may want to start dipping a toe in positions that you like right now. If you're watching on YouTube, I always forget to say this, but please hit the subscribe button below. Really appreciate it. Thank you. Again, big announcement coming. Probably next week I can say something about this. Getting really excited about a new venture that's taking place. VIX is up about 10% today, so it's a good move in the fear gauge. Up over 20 again. And the 10-year note is up about 3 basis points to 1.69. Let's take a look at a stock. We're going to do the marketing language here.
Stock Watch.
We engage and manufacture and are the maker of marketing of tools, equipment, diagnostics, repair information, and system solution for professionals, users performing critical tasks. Its products and services include hand and power tools, tool storage, diagnostics, software, handheld and PC-based diagnostics products. This is a long marketing language thing, by the way, and you're not going to know this company anyway. I never have invested in it, but I'm kind of looking at it thinking maybe I should have. What is it? Snap-on tools. Snap-on tools at a lot of car parts, a lot of car business places use these. And if we're going to get this big move in infrastructure, they're going to be buying tools. Stock has moved tremendously. And I think this is a different way to play that $1 trillion infrastructure bill. Stock technicals are strong. Stock's been up 34% over the last 3 months. I can tell you car driving's been down, and we're going to get car driving going back up. So auto shops are going to need to buy Snap-on tools. That's who buys them. Infrastructure, people who have trucks, going to be part of this highway development. People getting good jobs again as part of this infrastructure bill. You're going to see more tools being bought. Services are going back into full strength. Things like office and building repair, new industrial and building will take place. Dividend here is not terrible, about 2.14%. So you may want to dip a small toe in pre-earnings and then add more a few days after when the stock settles down a bit. I think it's a great reopening and infrastructure play here. The stock sits at 228. Again, earnings April 22nd, 2.14 dividend yield. The price to earnings on this is somewhat right in line with the S&P 500, so it's 19.6. Not terrible, not over the top like most of the growth stocks. Seems to be an amazing chart. I mean, if you look at the technicals on the chart, it's just breaking out. So take a look, Snap-on tools. So I got a question. Questions from Barbara. And Barbara wants to know, what is a REIT? And would I recommend any REITs right now? A lot of them have not done well because they're things like shopping centers. A lot of these places where people haven't gone in the last year. A lot of those REITs have really suffered. So Barbara, thank you for the question, and you can send the questions to jeffrey@jeffreycamus.com. So REIT is a real estate investment trust. It's a company that owns, operates, income and generating real estate essentially. And they'll have investors behind it that essentially put the money in to get the return from the REIT. They're kind of modeled after mutual funds, but they're like pooled investments with numerous investors. So it's possible, it's a way for you to get into real estate and earn dividends without buying or managing or financing any real estate yourself, which can be really risky or way more risk than just buying a REIT. And so there's some rules for a REIT. So the REIT or the REIT owner would have to invest at least 75% of the assets in real estate or cash or treasuries. And they have to make most of their income from about 75% from rents, interest on mortgages that finance property or real estate sales. Now, this is where it becomes good for investors. They pay a minimum of 90% of their taxable income in the form of dividends. So these companies really can't hold cash. They make cash on a regular basis, but they have to get rid of all their cash at the end of the year, which is why their dividends are generally good. So that's essentially what a REIT. Now, as far as what REIT I would maybe get into, there's one we sort of like, and it's Simon Property Group. And Simon Property Group, I'm going to read their marketing language. They operate a self-administered and self-managed real estate trust. It owns, develops, and manages retail real estate properties, which consist of regional malls, and premium outlet and mills. So here's what they're doing. They're in these malls across America that people are going to start going to again. You got to see and maybe think that in these malls, we've seen the bottom of the malls. Simon Property Group, I'll tell you, as an investor, it's got a nice chart. It's at about 111 now. But your yield on your dividend is really good here at 4.5%. I mean, that's a nice yield when you have a note, the 10-year note, only at 1.6 right now. That's substantially better than a 10-year note in a somewhat conservative investment. Generally with where commercial real estate is right now, you're going to still see a little more fallout. But there is a rebound, and we've lost a lot. And a lot of these companies have dropped greatly in the past year. So I think Simon Properties, who owns and develops retail real estate properties, is a good bet. It's up greatly this year. It's up around 30%. You can also buy maybe an ETF of REITs, which a REIT is really an ETF of real estate properties, but you can buy ETFs also that encompass all these REITs. And that could be a safer way to get diversity. You could be in a hospital REIT and a mall REIT and maybe a cell tower REIT. And there's some ETFs that actually do that. So that might be a way you want to play it too, which gets you more diversified. So if you don't want to just bet on the mall REIT or a hospital REIT or a hotel REIT, you can get an ETF of REITs, which really will diversify amongst all those REITs, give you a pretty good dividend, and maybe make it a safer way to be in the REIT structure itself. Thanks for listening. Appreciate all the questions. Appreciate the great feedback. Show continues to grow, which excites me. We're hitting all-time highs every week. And we'll see you again next time on Stock Smart.